Today was a fun day. It was the FOMC meeting, Wednesday, December 18th. Market had a little bit of an accident today, which is kind of interesting because what the Fed said and did and forecasted wasn't all that different from what people were expecting. They were expecting them to cut rates. They cut rates. They were expecting them to be more hawkish going forward. They were more hawkish going forward. The market had actually been pricing in a much more hawkish rate cut trajectory than the Fed had forecasted in September. So I don't think what happened today was necessarily because of the Fed, because again, what the Fed did was more or less expected. I think it was more because equities were just too exuberant. There was too much bullishness, too much mania in the market. I'm going to show you some charts that and some tweets that kind of attest to that type of mania that we've been seeing. If you've been reading the newsletter, you know that valuations are now at their worst level of all time using our preferred valuation indicator. So the market was due to have some of the air taken out of it. Now the question is, will the market stabilize and move higher again, or have we seen the top? We might have actually seen the top. It's not out of the realm of possibility, given the bullish mania that we've seen, given the valuations, given the fact that we are in a secular bear market and that the stuff that's been driving it has been basically running on a narrative as opposed to actual current earnings. So it is not out of the realm of reason that we have topped, but let's go through some charts and see what they say. So first of all, I think this sums up the mania that I'm referring to in the market. So this is a tweet, and it's talking about fart coin. So it's a meme coin that has $1 billion market cap. Last weekend, it had a market cap that was less than $1 billion, and it was a greater market cap than 85% of public companies in the U.S. So now that its market cap is higher and at $1 billion, it's probably has a higher market cap than 90, maybe 95% of the public companies in the U.S. So I think that is indicative of the mania that needs to kind of be squeezed out of the market before any type of sustainable upside can be achieved. We also see that Palantir, this tweet says it has a market cap of 166 billion, while it has net revenue, I think they meant net income, of around 200 million. It currently has a trailing price to earnings of 378 and a forward price to earnings of about 160, between 150 and 170. I can't quite remember. But that too is sort of a testament to the sentiment, the mood, the exuberance that people are willing to pay that much for a company on hopes and dreams of in what might be, or just because it's going up and they think they could sell it to somebody else in the near future. Here we see that 56% of American consumers, so that would be retail investors, mom and pop investors, people that are maybe just invested passively but don't really follow the market, 56% of them expect the market to rise over the next 12 months. So throughout 2025, the most of all time, having that expectation. You know that our thing is that when retail traders are leaning one way, the market tends to go the other way. So if you have an all-time record high number of percentage of consumers that think the market's going to go up next year, good chance it might not, especially after back-to-back 20, 25, 30% years. The statistics aren't really bullish going forward, given that type of trailing performance. And as we mentioned, the valuations are at all-time highs. Another tweet that shows the enthusiasm. Here we have U.S. equity allocation surges to a record high, and the cash allocation is at a record low. So equity allocation record high, cash allocation at a record low. Again, that speaks to the bullish sentiment, the overly bullish sentiment, which potentially got squeezed out, or at least initial squeezing out today after the Fed meeting. Again, just to show you how strange the market has been, before today's sell-off, the S&P was less than 1% from its all-time high, but it had the second most oversold reading in terms of its breadth oscillator. The McClellan oscillator is a measure of the breadth, the advancing stocks minus the declining stocks. It's a measure of breadth momentum. It was the second most oversold of 2024, despite the market being just a whisker below its all-time high. So that was a little bit strange. There's a lot of weakness underneath the hood, and there's one chart I'll show in a minute or two that's looks like a cartoon, how ridiculous it looks, and it's the S&P 500 equal weighted index. So just to recall, when you're looking at valuations, looking at the aggregate investor allocation to equities, it's at 0.529, which surpasses the 0.527 at the height of the dot-com bubble. The forward returns from that point onward over the next 10 years were pretty bad for the S&P. It lost 50%, then it bounced, then it lost 56%. So all told, it lost close to 60% from its dot-com bubble peak to 2009. And then it bounced from there, and we entered a secular bull market. As you can see here, GFC secular bull market, the AIE ratio had to go down to 0.26 in order to spur that secular bull market. Now we're at levels that initiate secular bear markets. And I think we've already been in a secular bear market since the end of 2021, a secular bear market driven by high inflation, where over the duration of the cycle, which will probably last at least until the end of this decade, if not into the next decade, the S&P will probably be roughly flat relative to inflation. But that doesn't mean it's likely going to just, meander and drift higher with inflation. It'll probably have strong sell-offs, strong rallies, and be very choppy in between. Now, here's composite equity relative sentiment. So coming into December, we thought, well, December is a seasonally strong month, and our measure of, your desired equity allocation, composite equity relative sentiment, was less than 50%, which is a bearish reading. If you're looking at it in a binary fashion, if you're looking at it at sort of quintiles or every 20% buckets, 44% is neutral bearish. Market tends to go sideways down in this bucket. But we were kind of concerned because December was, very seasonally strong. But one thing that we noticed was that survey relative sentiment plus machine learning was at 0%. And that was, one of the big drivers of why this composite was below 50%. And historically, when survey relative sentiment plus machine learning is below 10% equity allocation in a given month, market tends not to do well. And we have a chart of how it looks. So the blue is VTI, Vanguard Total Market Index, and the red is RSP, the S&P 500 Equal Weighted Index. So this is a conditioned on machine learning, survey relative sentiment plus machine learning being less than 10% in a given month. We set all the other returns for all the months where it was greater than 10% to 0. So we're just seeing the effect of the returns when it's less than 10%. That allocation, and as you can see, it's basically a stair step downward. It's been less than 10% several times this year. The equal weighted S&P has fallen each month, and the broad market rallied in June when it was at 0%, but the equal weighted market and small caps were down. The reason the broad market rallied was because of the AI Mania was in full swing. That's when NVIDIA was going crazy to the upside. But you can see that when it goes up, it doesn't go up a lot when it is positive. But when it's negative, it tends to just fall off a cliff. And as you can see, we're falling off a cliff, this month with the equal weighted index. It's down 7% and change halfway through the month. So if we get back to the market, so this is the Nasdaq. It's at an interesting juncture. It's at the bottom trend line of this rising wedge. Its relative strength index is making lower highs, so its momentum's deteriorating while the price is rising. The rise from the end of November has been a little bit crazy. Every morning, people rush to buy the Nasdaq and they rush to sell everything else. And so the rest of the market was going down, the Nasdaq was going up. It was extremely binary and likely not a stable market. And as you can see, we had a little bit of a breakdown today. This is the funny chart. This is the cartoonish chart. This is the equal weighted S&P 500. So every day this month, it's been down from the open to the close. It's had a red candle, meaning that its close is lower than its open every day this month. So I think that's 14 straight days where it's closed lower than it's open. And as you can see, it had this very big extended candle today. This red line here is the 200-day moving average. It's not that far from that. It'll probably have a rendezvous with that at some point, whether it meets it some point later this month or next month, or if it continues falling now. It's close enough that I imagine that will be a magnet and a target. This is the small caps, IWM, same story. It had 2 days where it was up from the open to the close, but more or less it's been down every day as well from the open to the close, whereas the Nasdaq has basically been the opposite, or at least the relative performance of the Nasdaq to IWM has been crazy to the upside. I thought I had a relative return chart in here. Maybe I do later, but this is Apple. So let's start looking at some of the stocks that are causing the Nasdaq to rise. So a long time ago, we showed this measured move pattern where you had this, bull run here. It kind of made a flag, and then it broke out of the flag. And if you take the distance from where it started to where it initially peaked and add that to where it troughed, that would give you 251.79. Apple hit 254 today and then pulled back with the rest of the market. So that target's been hit, which is another reason why maybe we've topped, or maybe the Nasdaq is topped at the very least, because Apple, their earnings and revenue have gone sideways for years, for several years, yet their valuation has gone up multiple times. I think their valuation multiple might have risen 2, 3, 4, potentially 5 times, while their earnings just went nowhere. So that's likely not a sustainable outcome, and it'll probably have to pull back dramatically and reprice to make the valuation ratios more sensible. But it hit this target, and maybe that was the final hurrah. We'll have to see. This is Tesla. This is another absurdity today. So since its late October earnings report, it's up 130%, and since the election, it's up at its peak today almost 95%. And it too has stagnant earnings and revenue. Now, apparently, people are pricing it according to this notion of having robo-taxis where no one has a car and robo-taxis take you everywhere that you want to go. There's tens of millions of them, hundreds of millions of them, and they basically are, the cars without drivers, and they're taking us everywhere. Maybe that'll happen, but it seems like there's a long way to get there. And I think people tend to hold everything else constant and think that Tesla will just capture all of that market, and there won't be any competition. But as we're seeing with NVIDIA, people also thought, NVIDIA was going to own, the data center market. But now we're seeing that Broadcom is helping Apple and Meta and potentially other companies make their own AI chips. And so that would eventually take revenue away from NVIDIA. So competition, people see that companies are making a killing and a windfall, and people want to get in on it. They come up with their own ideas. They want to compete. They want to take some of that market share. So I think the notion that maybe Tesla is successful, maybe they do have robo-taxis, but they probably won't be the only player. There'll probably be a lot of competition if it's such a huge market and so potentially profitable. So I think this has gotten way ahead of itself. And I think it has to come all the way back and more. So again, we'll have to see if that happens. But as long as it's still hanging up here, there's still some mania and exuberance in the market, because that seems a little bit unjustified given their current fundamentals. This is NVIDIA, which is another interesting chart. So it's been rolling over. So while Apple and Meta and Google and Amazon and Broadcom and Tesla, etc., have been rising, NVIDIA has been going down. So NVIDIA had its day in the sun. Now it's a little bit out of favor. Interestingly, it broke this uptrend line this week. Today, early in the day, it was trying to rally above that uptrend line. Fed meeting happened, and it fell in sympathy with everything else. So maybe that was a back test of this trend line, and maybe it's lower from here. So if that's lower from there, if Apple's lower, if Tesla's lower, if some of this mania comes out of these stocks, the Nasdaq could have a tough time from here. Now, if it just rallies back from here, then we're really in a manic period. But if there is some sense left, you would think that the Nasdaq would potentially struggle from here, have some headwinds, and the stuff that's really, really underperformed, like the equal-weighted S&P, the small caps, might have some potential positive relative performance compared to the Nasdaq. Here's Meta. So we've tracked this for a long time as well. It's in this long-term megaphone pattern. It tested the upper trend line of that megaphone pattern 4 times this year before it broke higher. Recently, in the late summer, it back tested that trend line on its earnings, which were not well received, and then it bounced like it was shot out of a cannonball. But now it's pulled back. So it was at almost 640 earlier this week or late last week, and now it's back down under 600. If it falls back inside this megaphone, that might be another sign that the Nasdaq is topped and we're, heading significantly lower. This is MicroStrategy, another example of a bubble. This one actually looks like it might be in the process of squeezing out some of that exuberance. Here's the relative performance of the Nasdaq to the Russell 2000 that I mentioned earlier or alluded to. So since the day after Thanksgiving, it's been 14 days since the day after Thanksgiving, and this has been up relative to, so the Nasdaq 100 has been up relative to the Russell 2000 on 13 of the last 14 days. The one day it was down like less than 10 basis points. It's generally been up from the open to the close each of those days, because as I mentioned, as the market opens, people rush to sell Russell 2000, they rush to buy the Nasdaq 100. If you look at their charts, one above each other, they have like this -1 correlation. When one goes up, the other goes down, and vice versa. But the interesting thing is that over this 14-day period, the Nasdaq 100 has outperformed the Russell 2000 by almost 11 percentage points, while having a Sharpe ratio of 26. I looked at all the 14-day periods dating back to when these two ETFs came into existence, so, their joint existence. I think that's back to around 2001 or so. So about 23, 24 years. They've never had a Sharpe ratio over 14 days equal to 26. The next highest is around 20. And then it falls off dramatically from there. So this is even more manic than the period in June and July, where the outperformance of the Nasdaq to the Russell was crazy before giving it all back and more. Whenever the July, it was a June inflation report released in July, came in cooler than expected, everyone rushed to buy small caps and sell tech. Now, I don't know if we're at that point now where people will rush to buy small caps and sell tech. So this might still have some more upside, and maybe it wants to close this gap at the very high that we saw in the summer. So that's a possibility. But I would imagine that if it does, continue higher in the manic way that it's been going, that we'll get another type of event like this where it sells off dramatically and the Russell 2000 outperforms for a spell. And I think longer term, given the fact that the Russell has much better valuations, Nasdaq has egregiously bad valuations, that we should expect this ratio to move in favor of the Russell 2000 over time. So I would expect that to trend lower, even if in the near term it continues this crazy behavior. So let's look at some macro assets. Here's the dollar. So the question, is the market going to stabilize and move higher, or is it continue to fall? So I think a lot of that hinges on what the dollar does, on what interest rates do. And there might be a parallel in the bond market to what we saw in the dollar this summer, this fall. So here throughout the summer, the dollar was falling. Even though dollar relative sentiment was bullish, the dollar was falling because the Fed was going to cut rates, and that was going to weaken the dollar. The Fed actually did cut rates, and they cut 50 basis points, and the dollar dipped below the support line, and it was very choppy for about a week after that Fed meeting, and it was just hanging around this support line. It was below it, but that turned out to be a false breakdown, and then the dollar went on this, 10, 12, 13-week rampage higher. Now it's broken out above this horizontal resistance line, and now the question is this a false breakout? If you notice, price has been moving higher, but the momentum, the relative strength index, has been moving lower, so you have this bearish divergence. Relative sentiment in the dollar is strongly negative. So as the dollar was rallying throughout the fall and into, well, I guess we actually haven't, it's not winter yet. So throughout the fall, the smart money was selling the dollar relative to retail. So throughout this entire rally, smart money was basically selling it to retail. Now that doesn't necessarily mean it's going to fall, but historically the odds suggest that the downside is potentially more likely than upside, based strictly on positioning, just forgetting about what the macro is. I think macro does a better job of predicting things. I think positioning does a better job than macro of predicting where things are going to go, because it's basically the sum wisdom of the players and what they're betting on and what they're seeing. And, a lot of how assets move is based on how, retail is leaning, and they tend to go the opposite way because, retail traders tend to be on the losing side more often than not. They don't lose all the time. They wouldn't play if they lost all the time. So they have to win occasionally. But more often than not, they lose. And probably when the stakes are highest, they tend to lose. So if retail is really long the dollar here and it broke out to this resistance, maybe that's going to be a false breakout. Maybe we see the dollar come crashing down through here. That might give stocks an opportunity to stabilize and move higher. Same thing with interest rates. So this is the Treasury bond future. It's the long bond. Maybe this is doing a little bit of a replay of what the dollar did in September when the Fed cut rates. Dollar broke below that horizontal support, and then it went strongly higher. Here, the long bond broke this support. Maybe this will be a false breakdown. Maybe we won't know immediately. Maybe it kind of chops around for the next week or so. But what's working in its favor is that relative sentiment in long duration bonds, composite relative sentiment. So looking at various positioning in currencies, precious metals, other bonds, in Fed funds futures, that positioning is in a configuration that is historically bullish for the Treasury bond. And it's been a pretty decent indicator of whether the Treasury bond would rise or fall, especially the last few years, but even dating back 30 years, it's been a very solid indicator of the Treasury bond performance. Now, so that's working in its favor, but what's working against it is that we are in a secular environment where long duration bonds will be essentially garbage. You're going to have negative real returns. If you hold these for the duration of the cycle, that's just baked in the cake, essentially. Even if we do have a period of deflation before inflation comes roaring back, it's just going to be a brief respite for long duration bonds. So if they do have a rally in them, it's not something that is probably going to last a long time, but it might be a tactical rally to kill time, to allow the market to make yet another high and lull enough people into believing that the market will never fall again before getting the real rug pull sometime potentially in 2025. So again, positioning is bullish for long duration bonds. The secular environment's very bearish. So let's see which one wins out. Let's see if this is a false breakdown. Let's see if the dollar is a false breakout. Here's silver. So silver relative sentiment or composite gold relative sentiment turned bearish over here at around 29 and change. It dipped, it went up, made a high, it broke out, it was a false breakout, it came crashing down, it went up again on some squeeze in the metals market, potentially having to do with tariffs, and if you had to deliver, the cost of delivery would skyrocket because of tariffs. So it got bought up, but then it got slammed back down again, basically to where composite gold relative sentiment turned bearish. But it's also at the 200-day moving average. But more importantly is that last week, as this thing was kind of peaking and then started to fall, well, actually, even before this thing started to fall, which is interesting because institutions essentially started shifting bullish as of last Tuesday, and this big sell-off was last Thursday. So while this thing was rallying, institutions were shifting bullish. So maybe they were covering and getting squeezed, and retail was selling. And that shifted the positioning, the relative positioning, into a much more bullish stance for gold and silver. Now, neither of them has turned bullish yet in terms of their relative sentiment. But given the sell-off that we've seen since last Thursday, it's not unreasonable to believe that retail has been forced to sell on this downdraft, in which case institutions were probably buying more on a relative basis, which means that given the bullish shift from last week, if you add to that, it's conceivable that gold and or silver relative sentiment could turn bullish by the end of the month or potentially early January. Dollar relative sentiment's bearish. If precious metals relative sentiment turns bullish, that would be the ideal landscape for precious metals. As you can see, silver is near its 200-day moving average. That would be a natural place for it to bounce, except the metals market is not that clean. It'll probably potentially go through that 200-day moving average to shake out even more retail players before stabilizing. And I would assume moving higher, given the secular environment that we're in, given the long-term cup and handle that's playing out in silver, that's already played out in gold, or the breakout has played out, it has much more upside likely. Given how suppressed silver's been, it's probably the most suppressed asset on the planet and manipulated lower. Once that breaks, it probably is going to scream to the upside. So this is something that 2025 could be the year of silver. We'll see, but that's my expectation. So here's XLE. XLE is not having a good fall here. In November into December, it's been down 4 weeks straight. It's fallen below this uptrend line. This is likely going to be one of the best performing stock sectors on the planet over the next decade. Oil is probably going to be in great demand, especially if the geopolitical trends heat up even more, which I expect that they will. It seems like a lot of people in positions of authority are really itching for a broader war in Europe and potentially with China. So oil will certainly trade at a much higher price, and energy stocks will likely trade at much higher prices as well. They're in a secular bull market. From 2010 to say 2021, when tech stocks and the broader market were in a secular bull, commodities and energy stocks were in a secular bear market. Now the tables have turned. So now this looks like it could very well easily fall to its 200-day moving average, or this would be the 200-week moving average. But that would probably be an amazing place to get longer energy stocks if it fell that far, given their likely performance over the duration of the cycle. But interestingly, Zero Hedge noticed that people were selling energy and using that to fund their long mega-cap tech stocks. ExxonMobil is the most it's been oversold since when oil went negative in April of 2020. So that performance is a bit extreme. I would expect a little bit of a bounce in the near future. But again, if the broader market falls, there's no reason why XLE couldn't fall to the 200-week moving average. But again, at that level, it would probably be a screaming buy, especially given their current, valuations. And if oil stays, here or higher, and it's been very stable the last several weeks, it's in a secular bull market. We should expect this uptrend to resume at some point. But we should probably also expect it to make a move either higher or lower in the near future. This stability looks unstable. So we'll have to keep an eye on that. But ultimately, stocks sold off probably because of too much mania. Whether they bounce probably has a lot to do with what the dollar does and what interest rates do. If the dollar has gone too far and it pulls back, and if interest rates have gone up too high and they pull back, maybe stocks can make another run at all-time highs. If those trends keep going in the same direction, if interest rates keep rising and the dollar keeps rising, stocks may have topped. So thanks for watching. I'll see you next time.